What's up, guys? Welcome back to DCA. So today what we're going to do is talk about the Bitcoin correction that we've just seen. So the market is now sitting at 54.3 at the moment, okay? And you can see this trend line that we've been on going back all the way, essentially back to the COVID capitulation event. All right, so we've been on this long-term trend from March and we've been trending up. We hit this trend line in September of 2020, rode it basically all the way through the end of October. Obviously, here is when we got fairly, we got quite a bit above the 20-week moving average during this time, and we stayed above the 20-week moving average all through basically the end of 2020 all the way to May. And due to the fact that we got so far above it, when we came back down to it, we weren't able to hold it. And that's a common theme that we see. When you get so far extended from a moving average, like the 20-week moving average, and you stay above it for a significant amount of time, it becomes significantly more difficult to hold that support level when you come back to it, which is exactly what we saw. We crashed through it and we came right back to this long-term support line that we've, been forming dating back to March of 2020. So we hit it in July, and that's when we used this support level to bounce back above the 20-week moving average. Holding this level is what you need to see for a bull market to continue. If we just quickly go back to 2017, and I've said this so many times now that I'm sure people are sick of hearing it, but look at 2017. We got above this 20 week. We needed to hold it as support in the beginning in order to confirm the bull rally. We did that. And then we just went off the 20 week all through the entirety of the bull market. And that's what I keep saying here. I keep repeating it because it's easy to get scared by what's going on. These are fairly big drops. I mean, I know in crypto, this isn't the biggest drop we've ever seen, but 8% in a day, it's not insignificant. Let's put it that way. So I'm saying it just to reiterate the fact that the 20-week moving average has been the level of support in a bull market numerous times in the past. So I think as long as we are able to hold that, then we will be okay. With that said, there's no guarantees we hold it, right? There's no guarantee whatsoever that we hold it. There's a lot of things going on globally right now. The stock market has been going parabolic for basically just as long, if not longer, than crypto has. There's a lot of reason to think we could come down to this 20 week and there could just be a large capitulation event right here. You can't look at these things in a vacuum, guys. You have to consider sort of the global picture as well. As much as we all believe in crypto, as much as we all, see the use cases for it, at the end of the day, it's going to be a risk asset. And when you have global uncertainty, people are going to sell off their risk assets. It's just how the market works. Now, a lot of times these short-term sell-offs are sort of overreactionary. And I think once people are able to gauge sort of, this new COVID strain, for instance, what the actual impact may be, we could instantly see a quick recovery. I mean, go back to the actual pandemic in March. You saw it tank and then it recovered within the span of a month, it had recovered and then we started into the bull market. I'm saying it to keep it in perspective. It's okay to be a bull, but it's also okay to be bearish at times. I mean, you have to look at the market through the lens of what's going on in the broader picture, okay? Not just what's going on in crypto. Crypto can be as bullish as it wants to be, but if the broader markets are bearish, it's going to come for crypto as well. So enough about that. Let's start by looking at the DCA risk index. So this is the DCA index. This is a machine learning algorithm model that I've made in order to sort of determine where market cycle peaks and bottoms may occur. Okay, so you can see this model has actually been quite good at identifying the market top in 2021, 2017, and back in 2013. It's also good at identifying where the bottoms occur. The way you would use something like this is depending on whether you're rising above 50 or going below 50, you would dynamically dollar cost average into the market as you're going lower, because these tend to be the very best times historically to invest in the market. For instance, down here when it's between 0 and 10, the market was at around $3,000. So if you would have been, piling into Bitcoin at that time, historically, you would have been pretty well off. Okay, so we have this type of model for, lots of the biggest blue chip cryptocurrencies. So the altcoins like Solana, Ethereum, Cardano, Polkadot, a few others. So we have it for a lot of the coins, and I'm working every day on making it for other coins. Now, this trading view indicator I have for this is available if you sign up for it on the Telegram channel that we have. Okay, so I'll leave a link to that in the description of the video. Okay, guys, so what we're looking at here now is a indicator that I've made. This is also available on the Telegram channel. And this basically shows the 20-week moving average. Okay, so the green line is when you are at the 20-week moving average. So for instance, let's look right here. If you go up and look at the chart, when we are on the green line here, we're at the 20-week moving average. Okay, when we're above this green line, so when we are moving up above the green line, that means we're above the 20-week moving average. And you can see, right here. So this corresponds to the market cycle top right here when we got this far above the 20-week. You can see that basically the extension from the 20-week moving average has been decreasing over time. Okay, so this is just a fitted line showing the rate of decrease over time and how we're expecting that it becomes more difficult to get significantly removed from the 20-week moving average over time just based on the market cap. As the market cap goes up, you need more money to come in to move the price of Bitcoin. Okay, so as that happens, you can't go up like we saw back here. You can't, this is 2013. You can't go from, at the 20-week moving average to being, 5 or 6 times above it anymore. It just takes too much money too quickly to do that. What we're looking at though is sort of right at this 60% above the 20-week moving average level. So between 60 up to around 100%. And if you look here in the past, when we get in between this 60 to 100% above the 20-week moving average level, and we don't go parabolic, we've often corrected back down to the 20-week. And so we've seen it once, okay, twice, 3 times, 4, 5, 6, 7, 8, 9, 10 right here. So we got up to the 60% level and then got rejected off of it to go back down to the 20-week. The price going back down to this green line is often a good sign for the market. It's how the market sort of refreshes. People take profit and then the market can continue. Now, with that said, it doesn't necessarily have to happen like that, like I said before. But in the past, every time we've got to this 60% level and then got rejected, we went down to the 20-week moving average and then held it as support. And that's critical. And that's what I, try and keep reiterating to people. So, people don't get scared and panic sell. You especially don't want to panic sell right as you're getting to the 20-week moving average. Okay. Because let's say you were back, let's say you were back here and you bought in right here at, let's say 51,000. Then it started correcting and it corrected down to the 20-week moving average. And let's say you panic sold. Well, you sold at 42,000 when you could have just waited slightly longer to see if we were going to get below that 20-week moving average. Because realistically, if you're down to 42,000, holding for another few more percent isn't going to, at the end of the day, be that big of a difference. But let's say you sold and then 2 days later, Bitcoin is up 20% from where it was right here. So that's more painful than it is to, sell right as you're getting to a known support level. And this isn't, like I've showed, this isn't just a couple times that, some rare event where this 20-week holds as support. This 20-week holds as support all the time. In fact, it's like I've said, it's how you sort of continue a bull run is by going down to this 20 week. It's just sort of how I approach it, guys. And you can sort of make up your mind as to how you want to approach this. But I'm looking at this as a positive coming down to the 20 week. And if you think I'm just saying that, you can go back to when the market was up at $64,000 and I'm making videos saying we need to go down to the 20 week to reset the market. Okay, so I've been saying it for a long time. This isn't something I'm just saying right now as we're, just a few percent away. In fact, we're probably about 3% away at the moment. So we are sitting at, okay, right now, we're about 6% off of the 20-week moving average. All right. So that's kind of, that's how I look at the market. And, this isn't just, I say this every time also, this isn't just for Bitcoin. This is a ubiquitous factor amongst various asset classes. Even go look at the S&P, go look at NASDAQ. They come down to the 20 week in the setting of a bull run, hold it as support, and then can continue moving on. All right. So the next thing I want to show you guys, and this is kind of interesting, the CME futures expire every last Friday of the month. Okay, every last Friday of the month. So what I've done is I've gone through and I've marked out the CME futures for every day or every expiration date this year. Okay, so from January until now in November. And what I've also done is looked at how big is the price swing from the open to the close, okay, and the absolute value of it. Because what we're looking to see is if there's, if not purposeful manipulation, if the market reacts in a certain way to sort of create these wild swings that occur on the expiration dates of these CME futures. And in fact, if you look here, so this is the day that the futures expire. 2%, so that's not much, 1.6%, but then, so 7%, 8%, -7%, -9%, 5.5%, almost 5, almost, 4.6, almost 3. And today we're sitting at, -7.5 when I made this. And right now we're at -8. Okay. So I've also then looked at what is the average price change on any given day. Okay. So not these CME future days. And that is only around 2.9%. So on the CME future days, on the expirations, that is, the average price change is around 5.5%. Okay. So around 5.5%. Now, I also looked at the 3-day period prior to the CME futures, and that's about 4% change. So the average close of the expiration date for the CME futures is about, approaching 70% or so higher than the average close. So that to me sort of indicates that, you shouldn't get too panicked about these wild swings that happen on the last Friday of a month, because we've seen it many times before, almost every single, 8 out of 11 times. In fact, the CME expiration date, or the futures expiration date, is very volatile compared to a standard day in Bitcoin's price history. Okay. So just to look at that again, on an average day, the average price change is around 2.9%. On the average CME expiration day, it's 5.5%. Okay. And then in the 3 days leading up to it, it's 4.1%. I definitely think, something like the CME futures is very ripe for manipulation of the market, because, it's not regulated, and they can come in and sort of try and swing the price into their favor, whatever that may be, long or short. It's just something to think about. And typically, we don't see a long-term trend necessarily form out of whatever happens on these last Fridays. So again, put it all in perspective, there's positive signs for the market and there's negative signs for the market. Sort of the global picture going on right now is that of uncertainty. So that's something to keep in mind. But you also have a lot of things that we could be looking for that we could use as a springboard to get to higher prices. Now, I will be watching for this 20 week, and it's what I keep saying. I'll be watching for this 20 week. If we go below it, well, you saw what happened in May. Let's just go look at other times we've got below it. This is obviously a black swan event, but right here in September of 2019, we got below it, and then we went down for 4 or 5 months, and then ultimately we went down for almost 7 or 8 months. Okay, so we didn't get back above that level that we were at right here. We didn't get back above it consistently anyway until out here in July. Another time we went below was right here when the bull market officially ended in 2018. Getting below usually means you have at least a few months that you're going to need to go down or tread sideways at best. And getting above and holding it means that you're very likely going to be able to go on a bull run. So let's watch for this, guys. Let's see what happens. If you guys like this type of content, hit like and subscribe. Head over to the Telegram channel if you want me to send you these DCA indicators, the risk model. And that's it for this one. So until next time, as usual, see ya.